Hi there, I'm Robyn Conway, General Manager of Managed Funds here at Fisher Funds. Now, our advisors are looking after our clients' investments, and we know that there's been a lot going on in the markets of late. We're here to talk to our Chief Investment Officer, Ashley Gardyne, and to answer a few questions about the tariffs. So with that in mind, Ash, US tariff announcements have been causing some market volatility recently. What's the latest on the tariffs?
Yeah, and it's good to get the latest because there has been a lot of talking about tariffs ever since the election, essentially. But it wasn't until last Wednesday, which Trump calls Liberation Day, that we actually got a bit more clarity on what he was thinking. The markets didn't like it. Essentially, the tariffs came in quite a bit higher than people were expecting. While there was an expectation that tariffs could be somewhere between 10 and 20%, we got 20% for Europe, but a number of markets like China at 34%, and some parts of Southeast Asia that are big exporters to the US saw tariffs of 30 and in some cases 40% plus. So it was certainly more significant than expected, but what we still haven't seen is what the retaliation is from different markets. We've seen China come out and say they'll put 34% tariffs right back on the US, but we haven't seen any announcements yet really from Europe or other parts of the world. And that's really going to be key to see if people try and negotiate or if they just put reciprocal tariffs straight back on the US.
Yeah, definitely. And so what are we thinking is going to be the potential economic impact of these tariffs?
And again, it's hard to understand the economic impact until we know exactly what's going to happen. Will there be some negotiations or will there be further escalation? What we know at the moment is based on the tariffs that have been announced, there will be some sort of impact to US economic growth and inflation. And economists are currently forecasting, let's say, a 1 to 2% increase in US inflation and a 1% drop in economic growth. And that inflationary impulse is quite an important one. It's effectively like a tax on the US consumer just at a time when they're already struggling with cost of living. So it has the potential to be quite harmful for the US economy, which is why markets have been falling.
So what's been the impact on the investments in the share market, both globally and for us here in New Zealand?
So the impact in the New Zealand market's actually been more muted than what we've seen around the rest of the world, sort of a 3 or 4% impact so far since Liberation Day. But in the US, we've seen a 10% decline in the US market, and that's been similar in other parts of the world like Europe as well. Some indices like the tech-heavy NASDAQ index is off a little bit further still. But if you think about the S&P 500 index, it's off about 17% from its highs earlier in the year so far. So it has been a pretty significant market impact, which really just reflects the level of uncertainty that we're seeing about what might happen next. On the flip side, though, there are some great businesses that we've been following for a long time who have seen their share prices fall 25-30%. So volatility isn't just a bad thing, it also does create investment opportunity as well.
Yeah, absolutely. And I know you don't have a crystal ball, but what's likely going to be the impact on us in New Zealand?
Yeah, so hopefully, as I mentioned earlier, the impact on New Zealand will be more muted. With that 10% tariff rate, it's certainly lower than what they're faced with in Europe. And if we look at the size of our exports to the US and do some maths around that, there could be let's say a 0.2 or 0.5% impact on economic growth here in New Zealand. That's some of the initial estimates that we've seen. But it's hard to know until, again, we see what other markets do with their retaliation. A follow-on impact could be that if we see lower growth in Asia as well, which is important trading partners for us, it could potentially have a bit more of an impact. But there are also some really important offsets as well. If you think about China, for example, they're going to have to find other markets for some of their exports. So you might start to see things like electronics or maybe electric vehicles being sold down here at better prices. So we may actually have a bit of a deflationary impulse as a result of this, which could potentially be a good thing. And likewise, if you think about us trading and competing with other nations like France, for example, we have a small advantage now in terms of a lower tariff rate than the EU, which could help our wine exports as an example. So it's all very fluid at the moment. We're going to have to see exactly what happens over the next couple of weeks, but it won't be as bad for the New Zealand economy as the rest of the world.
That's great. Thanks, Ash. And how does this impact Fisher Funds' investment strategy?
It doesn't really change our strategy very much at all, but it does change perhaps where we're looking for investment opportunities. So we've had the same investment approach for about 26 years. It stood us in really good stead right through the global financial crisis, COVID, the last trade war, the sell-off we saw in 2022. But essentially what the team does at a time like this is they're looking through their portfolios to make sure they're still really comfortable with the investments they hold and making changes there if they need to, but then quite quickly pivoting to look for new opportunities. And I mentioned earlier there are some great businesses with share prices down 25-30%. So the team are really busy trying to figure out how we take advantage of this.
Yeah, that's great. And the very important question, what should KiwiSaver and managed funds investors be doing about that?
I think it's really important to take a long-term view and realise when you look at longer term, actually, we've had lots of these similar events previously, whether it was the COVID shock 5 years ago now, the sell-off we saw in 2022 because of higher inflation. These are sort of par for the course in markets. We expect a 10% decline in markets every 18 months or a bigger 20% plus decline every 5 years or so. So it certainly is the price of admission, this volatility for an investor, and the worst thing you can do at a time of volatility is make changes to your settings. So if you really want to give one of your advisors a call, reach out and see if there's anything that you need to do. But in reality, the best thing to do is just to sit tight.
Thanks, Ashley. Great piece of advice. And one thing we'd really encourage our investors to do is seek out advice from advisors, especially in times of volatility, ensuring that they've got the reassurance that they need. And we've got a large team of people here to help out with our clients. I'm more than happy to answer any questions that people have. Thank you for your time.
Thanks for having me.